With increasing prices of just about everything, runaway inflation, and falls in disposable income, you know that parting with your hard-earned money can be difficult, even at the best of times. But if you've just started investing, you might be even more cautious about where your money goes. Buying shares in a company or any kind of investment asset can be hugely stressful. Buy too soon and you risk regret if the price drops and you miss out on a discounted stock price. But if you wait it out and the share price ends up rallying upwards, you'll feel gutted that you missed out on a bargain. Dollar or pound cost averaging is an investing approach that tries to minimize these risks by building your position in an asset over time. When you dollar cost average, you invest similar amounts at regular intervals rather than just investing a lump sum all at once. For example, when you feel like the stocks are on sale. Instead of trying to time your entry into a stock position, you just consistently buy in at a range of different prices. The key is consistency here. The great thing about the stock market is that it often rewards consistency. Dollar cost averaging forces you to be consistent because you make your investments at set times, regardless of the price. For instance, say you've done some research and identified company A as a good investment. You have £5,000 to invest, but instead of buying £5,000 worth of company A stock right now, you might decide that on the 15th of every month, you're going to deposit £1,000 into company A over the course of 5 months. 1 month you might be buying when the prices are high, or the next month you'll buy when the prices are quite low. The main goal and point of all this is that you stick to a schedule that you have in place because it stops you from trying to time the market. Another added benefit is that it can be an effective way to take the emotion out of investing. If you've committed to an investing schedule, then it's difficult to become overwhelmed by indecision or doubt that might even prevent or delay you investing in the first place. If you're new to investing, then it's probably natural to feel some kind of nervousness, I know that I did, when you make your first few deposits. But if you have a schedule in place, you'll get used to flexing your investment muscles every week or every couple of months to the point where you don't even give it a second thought anymore. Timing the market really is better than trying to time the market because it could leave you missing out on a really good deal and could also stifle the benefits of compound interest, which is essentially interest on the interest that you build up over time. So going back to the company A example, say you buy £1,000 worth of stock for 5 consecutive months, say from January to May. Let's also imagine that on the days you buy, the stock is trading at £50 in January, £40 in February, £20 in March, £40 in April, and £50 in the final investing month of May. During those 5 months, you would have gone over a bit of a roller coaster ride as you stuck fully committed to your investing schedule. But by the final month, the stock price would have eventually ended up at its original price of £50 when you started. What's really important in this example is that if you'd invested the lump sum of £5,000 on day one, you would only have 100 shares of company A in your portfolio. By dollar cost averaging, you were able to buy more shares with your money over a 5-month period, leaving you with 140 shares in total. It's possible to use this strategy for any type of investment, whether you buy company stocks or shares in a mutual fund or an exchange-traded fund. However, bear in mind that dollar cost averaging won't be everyone's cup of tea, and there are times when it works better than others. For example, in a bear market or when the price is extremely volatile. Also be worth feeding any negative self-doubt that might crop up with the benefit of hindsight. If the day after you make your first deposit, the share price suddenly rockets, it's quite clear that it would have been better to buy as many shares that you could have on day one. Or with the company A example, you could have got a total of 250 shares if you'd invested all of your money in March. But that kind of sentiment is unlikely to keep you motivated. The reason why dollar cost averaging exists as a strategy in the first place is because we have absolutely no idea which direction the stock will move. Dollar cost averaging isn't a fail-safe investment hack, and any strategy that you use is only as good as the stocks that you pick. So definitely do your own research when it comes to finding quality companies to invest in, or seek the help of a financial advisor. Life, finances, especially at the moment, can be stressful at the best of times. Investing really shouldn't be another worry to be overly concerned about. As Uncle Buffett once said, if you like spending 6 to 8 hours per week working on investments, then do it. If you don't, then dollar cost average into index funds. If Mr. Buffett's advice appeals to you and you want a hands-off passive approach to investing, then definitely watch my video on the easy way to invest in the stock market, which I'll link up here. Thanks so much for watching, and I'll be back in the next video.